The dark side of the wheel strategy that nobody likes to tell you about. So, for example, one of my favorites is XYZ, formerly Square. Now, let's say, for example, that you did a cash secured put in January 2025 when XYZ was trading towards its bottom Bollinger Band. And let's say you did a cash secured put for a month out at $70, collected some juicy premium. However, a month later, Block came crashing down. You took your assignment at 70 and have since not recovered. Well, what are our options with this? Okay, pun intended, of course. Well, the first and foremost is we would go over to our options chain and see what we're able to do with selling, right, calls on our 100 shares that we now have a cost basis of 70 on, right? So we're clicking sell a call, and I'm going to go out to my 30 days, and I'm going to obviously try to get rid of these shares at a higher price than what I bought them for. So I'm going to look at, like, for example, the 72 fives, right? Now, the 72 fives, I'm collecting $14 in premium. If I go to my covered call calculator here, right, my strike of the option that I'm willing to sell them for is 72.5, right? I'll put 72.5 here. All of my calculators are completely for free. Everything here is free. Join our free Facebook group. That's where all the links are. Link is in the bio for that group. But our purchase strike price is 70. Obviously, this is example purposes at the time of these recording. You can see our premium return is like nothing. Our profit on the shares, at least we get out of our stock, right? So it's just not good. And oftentimes, right, you might not even be able to do covered calls that are even a month out. Now, if that happens, you have a few choices to make. If you don't believe in the company anymore, which is a big problem in my opinion, always do the wheel strategy on stocks that you believe in. You have the option to just go out there. It's trading at 56 right now. You bought them at 70. Cut your losses and capture some of your money back if you just completely have lost faith in the company. The second thing that you can do, and I've unfortunately had to do this a few times, is I'll usually go out way further in my expiration date, right? There's been times where I'd go out at almost a year, right? So for example, here, if I'm like, I just want to potentially sell this stuff in a year, I'm not a big fan. I just want to be able to maybe sell my shares for a little bit higher than what I bought them for and collect some premium. So I'll go 300 days out right now. I very rarely do this. This is a very big decision because this stock could go all the way back to 100. There's a possibility of that. But you could see here, we have a lot more options with our strikes, right? Like, for example, our 90s, we'd still collect $244 up front from the options buyers today. And if in 300 days from now, Block hits 90, we would sell our shares for 90. But, right, this thing could run up even a lot further. So you have to be comfortable locking up that amount of shares for you. So as an option seller, you do still have, pun intended, options. They're just a little bit more limited. If you want to learn more about selling options and the quad option strategy, make sure to like, follow, and drop any questions that you have.